Everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, generally related to three different topics: wealth building, commodities, and/or financial topics that I'll cover, give my opinions on. So we're going to dive right in, take a look, see what people on Twitter are sharing, and we'll get to it. If you want to follow me, it's at @FinanceCoreFinance, and if you want to join our community, finding-value.com, where I dive deeper into these topics, sectors, looking for value, and more specifically, looking for individual companies to invest in for this commodity bull market that we are in. So I'm starting with uranium versus the S&P 500. I know a lot of people are pretty negative on uranium. I'm seeing posts percolate out of the Twitter of people holding certain individuals accountable, which is a little bit ridiculous in my opinion. What we have here and what the setup is that big picture view, which is very important to keep in mind, is the momentum for uranium versus the S&P 500 was down. We based out starting in 2017, all the way up, and we broke out in 2022 out of that base here. Now we're in an uptrend. And I know it doesn't feel like that. A lot of people are mad. They're angry. Well, uranium, it's just going to go straight up. No, it's not. It means you haven't been exposed to the markets. They're going to move up in waves. Last bull market, we had a whole bunch of 40, 50% pullbacks in uranium along the way of the bull market. This big picture view, if you look at the momentum, not the candlesticks, but the arrows, momentum down, momentum sideways, we are now in an upward momentum. I haven't changed that since 2020. I've been invested in uranium since 2020. I bought all of my original positions specifically in September, October, November of 2020. That's where I got my original positions, and I have added along the way. We've had higher highs and higher lows, but those lows that are created could be 30, 40, 50% pullbacks. And people don't like that. But guess what? The market doesn't care what you like. It does not care. So if you want to be a part of this game, you need to learn the game. You need to know the game, and you need to know that the game doesn't care about your emotions. It does not care. So how can you conquer this game without getting emotional like a lot of people are? That's the retail sector. They get emotional. They sell when things feel bad and they buy when things feel great. You got to reverse that. If you want to be good at this game, you got to buy when things are low. And if you're going to sell, you want to sell when things are high or overvalued, or when sentiment is good and overvalued. That would be the ideal thing. So now that we're going through a slowdown in the market, obviously uranium equities, and I don't have the equities here, are being impacted. You can see the pullback in uranium versus the S&P 500. It's not the end of the world. We're still in a bull market. And I don't know how people, it's hard to train other retail investors who are so emotional, and some people will never get it because of their personality traits, how you have a bull market on the secular trend. We've been in a bull market since about 2020, the bottom here, and we've been moving on up. Higher highs, higher lows, we're coming on up. And that's going to continue here, I think, coming up in a big, big time way. Why do I think that? I think the S&P 500 is going to go sideways or lower over a period of time, 5 to 10 years probably, and then uranium is going to go up. Why is uranium going to go up? I don't think uranium is going to be any different than the other bulk of commodities in terms of the main reason why it goes up. It's going to be the denominator. Uranium priced in dollars, the dollar value is going to go down. And then money's going to shift from the S&P 500 and some of these other sectors into hard assets where the dollar is declining. Or it's going to move to emerging markets or other areas where those currencies are going to go up against the dollar. That's the exact time that uranium goes up, oil goes up, and all these different commodities. So this still looks good. This looks like an entry point, not a selling point in uranium here. Now, does that mean that the entry point is right this second? Not necessarily. We got to see buying pressure show up to uranium again. And we want to see that this yield curve doesn't completely bring us down to a little bit lower level. That's what we have to monitor. But we should be looking at it from a bullish perspective, from a long-term bull perspective, not from a bearish perspective. You cannot make money if you're ultra bearish because you're not going to buy. You're not going to get back into the game. Here's platinum ratios versus other metals, and I was reading some other posts about me taking accountability for platinum or something like that. Well, this is what I see, guys. I see platinum as incredibly cheap. Does it mean that it can't get cheaper? It can definitely get cheaper. What someone should do, or what I do more specifically, is it's in the buy platinum area. We should be looking for a long position in platinum. Now I'm firing off, I'm buying stuff because I know I'm below the cost of the producers. I know they're pulling back on production of the platinum group metal trio, which is rhodium, palladium, and platinum. I know I'm at a cheap ratio against gold, and I know that gold could still outperform platinum in the short term. Why is that? How do I know that? Because of the market conditions. When the yield curve uninverts and we have that uninversion or a slowdown in the market, gold generally outperforms most other assets. This could still go down further. That does not mean that platinum in dollar terms is going to get completely wrecked, but it could. It could in a slowdown. It got down to $600-700 an ounce in 2020, and I purchased the crap out of it. That could occur again. That very well could. And the time to be long gold is now. But during this next 6 months, when we see weakness, that's when you load up. That is what it feels like to purchase when everybody hates it. And eventually, this is going to work its way all the way up to the buy gold area, where we make, if we buy at 0.4 and it goes back to 2, which is this area up here in the middle, that means, let's just do from 0.5 to 2, you get 4 times your metal. 4 times the amount of gold if you buy platinum down here. It's over 4x if we get back to the 2-0 ratio. That's how I'm making all my money, or my ounces returns. I did it with other metals previously. Speaking of other metals, I purchased palladium in 2005 when it was here, and in 2009 when it was here. I bought them in this area here. Now, in 2005, I had to wait where it started to really move in 2010. So I waited over 5 years for this move here. And people are going to say, oh, that was dead money. Oh, that was dead money for 5 years. You should have invested in something else. Okay, whatever. So I bought a bunch here, and I swapped it in April of 2020 because I thought that this was going to be the lowest point that this was going to get into. And I was a little lucky to choose that time. We had a big flush out in platinum to the downside. And palladium was still very resilient up at the top. It was doing a topping pattern, in my opinion. So I swapped it. And of course, I don't know the future, and that's when I did. I did it at 0.38, I think, or 0.35 or something like that. So I got about 3 times my metal. Now we're back to 1. So what does that mean? So I'm just going to make the numbers easy. If I bought 10 ounces of palladium here, it went all the way down. In this ratio, I got 3 times the metal. So I bought 30. I got 30 ounces roughly of platinum down at this bottom. Now I could swap my platinum back and get 30 ounces of palladium at a 1-to-1 ratio. That means I went from 10 to 30 at this point. And I'm not going to swap it, but that is the increase that I got. I got a 3x increase. Now, when I purchased this palladium up here, I purchased it at $200 and something an ounce. I think it was like, I can't remember the exact pricing, 200s of something. It was a long, long time ago. And if I swapped it down here, and now I look at the ounces here, if I had 30 ounces, so if we were to do the math, I'm just going to bring out the good old calculator here, guys. So if I have 10 ounces at $250 an ounce, that is $2,500. All right. So now I have 30 ounces because if I swapped it, it'd be worth 30. Or you could say I have 30 ounces of platinum from the 10 ounces I originally had. 30 times $1,000 is $30,000. $30,000 divided by my original purchase price of 2,500 is a 12x increase. How many people have 12x their money since 2009 or whatever to where we are today? And I think this is going to go way up. Now, if we go back up to if we go up to if we go back up to 5 or 4.5, let's just do 4.5 and let's bust out the calculator again. So if we go up to 4.5 and I own 30 ounces, it'd be 30 times 4.5. I now have 135 ounces of palladium if I swap it at that ratio. I started with 10 back in 05 and 2009 for this example. And add a zero to it. It could be 100. Now you have 1,350 ounces if you started with 100 ounces. What does that mean? At that ratio up here, let's say that platinum is $4,000 an ounce. So it would be 30 times 4,500 or something. You'd have $135,000 from an original purchase price of 2,500. It's 54 times your money is what you would have. And I'm doing this with a good chunk of my money. I'm swapping the ratios back and forth. You buy here platinum, you sell you sell your platinum and buy palladium in this area, and then you just do it again over and over. It's not fast, it's not quick money. It's a way to build wealth, to build ounces, and you're doing it out of the system, which is a diversifying investment strategy. It's that simple. And here's platinum versus silver. We're at a very low level. We've got a 3-hump consolidation that just finally is probably going to end here at some point. It'll probably go down in one last washout sale where silver's going to rip. Platinum will probably lag behind given the market conditions of the slowdown and the uninversion of the yield curve. It'll be the best time to buy platinum probably of a lifetime. That doesn't mean that platinum in dollar terms will necessarily go down. It could. I'm not saying I don't know with 100% certainty. Maybe silver goes to $50, $60, $70 on a big breakout, which I think is going to occur. And maybe platinum doesn't really go anywhere. Or maybe even platinum goes to $800 or $700 while silver goes up, doing that washed out fake breakdown where it's a slingshot to the upside, where then the right market conditions come, the dollar drops, inflation comes, platinum rips it because platinum is a more inflation sensitive metal than silver and gold, and why I'm positioning in it. This looks really good for platinum, just an FYI. Here's the oil to Nasdaq ratio. I wanted to go over this one. So oil versus the Nasdaq, we had these big bear markets for oil or bull markets for Nasdaq, bull for oil, bear for oil, and then we're in a bull market, in my opinion, for oil. That doesn't mean that oil is going to go up immediately. But in the long term, the big picture view, we need to be bullish on oil with the paradigm that oil is going to go up. So that short-term pullbacks are buying opportunities. We have a weakening economy right now. We started at 2020. In my opinion, we are not going to go below the 2020 low. I think that we're going to create a higher low. And on the charts, if you look at a lot of the charts, they're going to be inverted head and shoulders patterns. We are creating the right-hand shoulder on the majority of the patterns. Now, I don't know how far down we're going to go in oil. No one does. But we should be looking at it as a buying opportunity, not as a selling opportunity. A selling opportunity would have been in 2008 because we were changing in a different market condition. Here, we are not. We are staying in an upward trajectory for higher interest rates, for inflation, for the credit to be expanded on the monetary side against new homes being built in the future, in my opinion. We're still in the real estate cycle of an expansion phase. There's a bunch of different things. But that's how I view the world. We should be bullish, not bearish, coming from a very low point. And we could go all the way back up here as a possibility out in the future, depending on how much inflation is created. This is all being driven by the dollar, not oil and not the Nasdaq. Money movements and the value of the dollar and interest rates. That's what's causing the majority of this. And if they pump the system with credit, oil's not going to be able to catch up. So oil price is going to go up because they're creating credit at a faster pace than oil. Here's Fernando. This is the S&P 500 big picture. In panic yet? Don't be. We're just starting. 4,100 first target before any big rebound happens. We'll We'll post lower time frames in next post. So this is a big picture view of a potential top. And then the move lower. This is what occurs during commodity bull markets. You get a big surge higher, you get in some big rising wedge, you get a topping pattern, then it rolls over. Then what happens, this is generally caused by an increase of interest rates. Then what comes next is a weakening of the dollar. The weakening of the dollar is what's going to cause a big surge in commodities to make their big move up in this third leg. That's what occurred last bull market in 2002. Now, we could get pulled down with this depending on how fast this sells off. As money sells and leaves, there could be margin calls and liquidity events and stuff like that. So that's what could come next. And in the short term, it's going to give us a buying opportunity in commodities. RevCap says freight is in a depression right now because enough capacity was added to support 2021 shipment pace, and there is a 0.1% chance we will ever need to ship that much product again in history of the country. Once in a generation retail sales euphoria, stimmy plus category shift. And that is true. And I wasn't even thinking about that. We probably built too much capacity in shipping and trucking and all those things. So it would look like there's a recession in it, which is the stimulus overhang that I called it. If your parents made 80K in the 1990s, you'd have to make about $250,000 in 2024 to have the same life. 246,000 is now the new 80K. So that's why that he says that's why we own Bitcoin. I will say when I first started working, I felt like it was easier in terms of money and how much I made when I first started working than I did a few years ago when I stopped working. That is, and I made more money obviously, but I didn't make that much more to make up for inflation. So that's my, I don't know, personal feeling there. Here's Divinology. He says, when my passive income is greater than my yearly expenses and growing faster than the rate of inflation, then I will consider myself retired. Yes, I think that's a great way to measure this. If you guys are looking to figure out how to retire, you got to get your passive income up higher than your yearly expenses. And I think that's a really good way to measure it. That's my goal. And I'm trying to do that. I have met that goal, but the problem is a lot of that money is in accounts that I can't take out. It's in retirement accounts, like Roth IRAs and stuff like that. So my goal is to do this in an individual account where I can access that money before 59 and a half. So that's one of my goals. There's some other goals too that I have. So here's another one. Global Market Investor says used car prices fall as if there is a crisis. Used car and truck prices fell by 10.1% year over year in June. This is in line with the 10% drop in the great financial crisis of 07 and 09. Overall, U.S. wholesale prices of used vehicles fell for 22 months straight, and you can see the big move lower. This is indicating weakness in the market, though. This could also indicate that stimulus overhang that I talked about a long time ago. The stimulus overhang means that there was a bunch of stimulus put in the market. They raised rates to a level that may not be sustainable by the market itself because there's so much stimulus added, that fiscal spending they did, so much stimulus added to it that maybe the rates are too high for a sustainable market right now. And we could experience a slowdown, which I think is what they were trying to do. Now that we're getting the slowdown, they're going to lower interest rates. And that's when we want to see if the credit comes back from the real estate market. That's kind of what I'm looking at for the next move. Natural gas spot prices are trading in extreme contango right now, while oil WTI is in backwardation. So basically, in his opinion, the markets are predicting a significant fall in oil and a significant rise in natural gas. And some people use these forward curves, backwardation and contango, for that. So contango means that the short-term price is lower than the long-term price. Backwardation means that the short-term price is higher than the long-term price. I don't know. I don't think this has any predictive abilities, although he's kind of using this as predictive abilities. I don't think it has predictive abilities. I don't. But I'm here to share it and what other people are sharing. Breaking, the U.S. personal savings rate dropped to 2.9% in July, its lowest print in 2 years. Savings as a percentage of disposable income are is at its second lowest level since the 2008 financial crisis. Now the savings rate has declined in 14 consecutive months. To put this into perspective, saving rates average about 6% in the 09 to 2019 period and 11% in the 1980s. On top of high inflation, wage growth has stalled, which has led to record usage of credit cards and low savings rates. Consumers feel like we are in a recession. Very similar this time here, which was '02. Rotisserie chicken, hot dog combo meals, and bullion. Costco CFO said total e-commerce commerce quarter was led by gold and silver bullion, gift cards, and appliances. Gold bars are selling out in hours with an estimated 100 to 200 million in sales per month. Holy crap, in hours? That's good for them, I guess, for sales. Global market investor, this has not happened in the last at least 35 years. The spread between the 2-year yield on the government bonds and the Fed's rates fell to minus 1.686, the most in over 3 decades. In other words, the bond market expects the Fed to cut big in the next months. The Fed is behind the curve as never before, and that's what the spread is. They're saying that the 2-year yield is predicting a very big rate cut in the Fed funds rate, and that they are behind the curve. Here's Grady talking about gold and silver. Very big picture. This is still a massive divergence between gold and silver. Last time these two had a larger divergence like this, silver played catch up hugely. And this time, silver will break out of a 45-year cup and handle. So the overshoot this time should be massive for silver. So this is the divergence now, and you can see in history that there's been these overshoots for silver to go way up above gold. We have a long way to go higher for that to overshoot. So silver could be in a very good opportunity for a big move to the upside here. Finance a lot says natural gas. You can see that we're squeezing up in the corner here in May of 2024. Very similar to what I would say is 2002. You've heard me say 2002 a couple times now. That's where I think we're at. I think the dollar is going to drop, and then natural gas will probably rip too. Very similar setup. This is the long-term bear case for oil is natural gas. So what's occurring, at least over in China, it says China road diesel, gas oil demand displacement, fuel efficiency improvements on 2019. We've got fuel cell displacement, which is basically nothing. And then we've got LNG, CNG, which is compressed natural gas displacement, which is taking an impact here. Then we have electric displacement and total road diesel demand for displacement. So it looks like natural gas could be something that is filling some of this gap here. It says LNG truck sales impacting Chinese road diesel demand. So LNG is going to be a big one, and we're putting in a lot more LNG. I think natural gas in America, big investment opportunity. Something to think about following the WNA London 2024 and the 2007 bull enrichment peak, which is SWU, at $160. Conversion $12, and uranium at $137 a pound. Today, SWU is 176. We've got conversion at 72 and uranium's at 80, respectively. So utilities will pay up to get what they need. Uranium will exceed the previous high, in his opinion. So we still have some uranium bulls out there, and I'm a bull too. I still think that uranium's going to go higher. We're just going through a short-term pullback or slowdown in the market. Here's Logan. It says new listings data this week, 62,000. We've got new listings data this week is that. So 2009, it was 277,000. 2010 was 383, and 2011 was 361. We are nowhere near the listing data in 09, 10, and 11. Credit channels run inventory channels. Stop dancing with a ghost. And these are foreclosures and new bankruptcies are still below pre-pandemic levels. They're super, super low here for foreclosures and bankruptcy. Super low compared to what we had in 06, 07, 08, which was just ridiculous. So a lot of these people are referring back like we're going to get this huge crash like 2008. I don't think so, guys. That was a real estate market dump. We don't have the same conditions in the real estate market in terms of forced selling that we do today. It's not even close. Coyfin says in several of Peter Lynch's old books, he shared a charting technique, later dubbed the Peter Lynch chart. A quick way to tell if a stock is overpriced is to compare the price line to the earnings line. A quick guide to producing these charts in Coyfin. So what we're looking at is the price versus the earnings. The earnings are the dots here. And then if you get a big gap like this, like Walmart here, then you could say it's overvalued because it's grown faster than its earnings. And the leading, the pace leader for the majority of it is when your earnings go up roughly the same pace that your stock goes up. Whenever you get a big disparity between the stock price and then your earnings rate of change, that's when you can see that you're overvalued. So that's what they dubbed the Peter Lynch chart. Metals, weekly price and performance. Looks like last week we had some pretty poorly performance. Palladium getting smoked, zinc, tin, nickel, lead, aluminum, silver, all getting hit pretty hard. The only thing that was up was molybdenum, lithium, and uranium was up slightly. That was it. Rough week for the majority of assets. And that's what I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website. Mayday coupon code is still active if you'd like to use that coupon code for a discount. And that's all we've got. So we'll catch you later. This is Finding Value.